It's been 10 years since the financial crisis started. Lehman Brothers out of New York on Wall Street went bankrupt. It was the fourth biggest investment bank in the world. And out of nowhere to the general public, the world seemed to stop. Today I want to go into details about what happened, who's to blame, and where are we today, 10 years later. Did we learn anything? And what is the prospects of the future of another financial crisis? To understand the financial crisis that erupted 10 years ago, you have to go back to the year 2000, year 99. The tech bubble got started. It was the first of generation of the internet companies. There was Netscape, there was Pets.com. Of course, Amazon was around, eBay was around. But back then, we all believed that the new world was finally coming, and tech assets got bid up to astronomical heights. A lot of investment went in, a lot of business started up. The whole thing ended up blowing up. The Nasdaq lost 80% of its value in a very short time. That meant that investment stopped. That meant that the Federal Reserve, the national banks around the world, they responded textbook by lowering interest rates, and it worked. Within half a year, we were out of recession and the economy was booming ahead. I still remember the party times, everybody buying cars and boats. They went to Best Buy, they went to Walmart and bought Chinese imported goods. The dynamic behind it was simply that interest rate got pushed down from a historical level, 6 to 8%. Of course, in the 80s, the interest rate was much higher, but historically we had an interest rate, a stable interest rate environment around 6 to 8%. Alan Greenspan, head of the Federal Reserve, he was called the maestro. He lowered the rates all the way down to 1%. The Federal Reserve fund rate was 1%. That meant that rates on mortgages went down dramatically from 6% down to 2%. And of course, when the general public buys a house, you don't look at the price really, you look at your monthly payment, how much can I afford? And when your interest rate is by far the highest expense of buying a house, when you buy with a loan, which everybody does, more or less, that meant that before, in a normal interest environment, you'll be able to afford a house at $300,000. All of a sudden, you're able to afford a house at $600,000. Did that mean that you get a much nicer house? No, it just meant that the market responded. That a normal average house went from $300,000 to $600,000. That meant in the years from 2002 to 2007, a lot of wealth got created. A lot of people, those who owned real estate, they got rich. They made $300,000-$400,000 out of thin air. When they sold their house, they got flush with cash. If they didn't, they took out a home equity line of credit. They took the money, they went down to the auto dealership, they went down to Best Buy, and they spent all the money. That meant the economy was booming, jobs were created. So it was a huge party back then, and there was no end in sight. The flip side of this was that the consumers, they had a party. They had the best time of their life back then. Everybody felt rich. But on the other side of the coin was the investors. And usually in society you have the private household that invest their savings. You have the pension savers that's being invested on their behalf by fund managers. And you have insurance companies. These investors, they are accustomed to a yield between 6 to 7, 8%, more or less risk-free. Of course, there's ups and downs. But you, as a pension investor, a lot of times you're promised 6 to 7% by your fund manager. And it was baked into the cake that if you pay a certain amount in, we'll invest it for you, and the time you retire, you have enough money to live happily ever after. But when the interest rates were this low, insurance companies, pension investors, they could no longer invest in a government bond that created a 6 to 7% yield because the rate was pushed down to 2%. So there's a gap from 2% to 7%, and that gap have to be filled somehow. Otherwise, the whole retirement scheme would fall apart. Insurance rates would have to go up. And the bankers, they created a product for that demand. And what they did, they looked in the market, who can we find that is willing to pay 6-7% on a loan? What they did, they loaned money on real estate to people who were usually considered not creditworthy. So borrowers who didn't have any asset, who had low income, maybe had a history of defaulting on loans, all of a sudden these people were able to get a loan on real estate. So these people all of a sudden, they bought houses, maybe a house that was worth $150 usually. All of a sudden, they paid $300,000 for these houses because they were able to get a loan now. When they lent the money to these people, they paid 6 to 7% on the loans, and the investors, the insurance companies, they were gladly buying these products through Wall Street, but in effect lending the money to not credit-worthy borrowers. The insurance companies were happy, the pension investors were happy, the general population was happy because they got now 6 to 7% yield on their money and their own house went up. So there was no downside to all this, at least it seems so. 2007, the subprime crisis erupted in America, and what happened was all those people who got those loans, they stopped paying. All of a sudden, these guys, subprime borrowers, they couldn't afford it any longer. They didn't have the means, they didn't have the capacity to save, to make payments on time. And so all these loans that was made to these subprime borrowers, they went into default. The logic was, of course, okay, if people they stop paying, we're just going to take the house back and we can always sell the house again because we know that house prices only goes up. So there's no risk in it, everybody was happy. And it worked in the beginning when the subprime crisis evolved. You took the house back, you put it back on the market, and within no time it was sold again and you were made whole. You didn't lose any money. The money you lent to the guy who didn't pay, you got it back by foreclosing on his house. But all of a sudden, a tsunami happened. All the guys seemed to stop paying at the same time, and that meant when you foreclosed on a house to recoup your money, there was no buyers out there. A lot of times when you foreclosed on a house that you lent 300,000 on, you only got 30 or 40 grand back. So there's a huge losses presented to all these investors. Of course, when this happened, the music stopped completely. The bank whose balance sheet was very stretched at that time, and that means in layman terms that the banks, they only had equity worth 5% of their assets, meaning every time the banks, they lent out $1 million, they only had 50,000 in equity, 1 to 20. So of a loan pool of $1 million, if the banks, they lost more than 50,000 on a loan of $1 million, the bank would go bankrupt. That's how stretched the balance sheets of the banks were back then. Of course, when this happened, the banks stopped lending money. The spending party at Walmart, Best Buy, at all these dealerships stopped overnight, and the banks was facing bankruptcy. And there we are, that's 10 years ago today. The music stopped, all the consumption, everything stopped. The world changed as we've been knowing it. When the party stopped, when the music stopped playing, of course, like always, it was the little guy, the lowest guys in society who got hit the hardest. People who had no savings, no cushion, lived from paycheck to paycheck. They got thrown out of unemployment. The unemployment went up to 10, 11, 12%, even in some part of Europe up to 25%. So the financial crisis was real. The pain was real. We haven't seen anything like this since the 1929. The general public, the politician, they looked for a scapegoat. Who was to blame for this mess? And everybody pointed at the bankers, they lent money to people who wasn't supposed to get a loan. The bankers, they created these weapons of math destruction, credit default swaps. They fooled us, everybody, to invest in this. A lot of savers lost their money. So everybody kind of pointed fingers at the banks. But when you look deeper into what is the real cause of all these things, for my eye, it's not the bankers to blame, because the bankers, they just responded to a demand in the market. Demand in the market was, we want investments that give us higher yield than the 2%. Why did we have a 2% yield all of a sudden on government bonds? The Federal Reserve, the government, they put the rates down. They lowered the rates artificially to stimulate consumption, and it worked. But investors on the other side of the table who needed to invest, who needed yield to guarantee low insurance premiums, to guarantee pension savers were able to retire when that time came. They needed yield on their investments. They were forced out the risk curve. They couldn't sit in your low risk government bonds any longer. They had to go out to fulfill that promise to the general society as savers. That's why they bought those loans. That's why people who shouldn't have been granted a mortgage, they were able to get a mortgage. So when you look deeper into it, the banks, they just responded to a market demand. We want higher yield. And in hindsight, everybody could see we shouldn't have loaned this money to these people. But back then it seemed natural. House prices go up, They will always go up and they never go down because house prices have never gone down since 1929. So instead of pointing fingers at the bankers, they just responded to a general demand in society. Just as if you have a cake shop and all of a sudden everybody wants cake with chocolate on it, you know what? I'm going to make that. I'm going to satisfy my customers. The finger to point at is the Federal Reserve, is the national banks around the world. They lowered the interest rates and that created that problem. At the same time, lowering the interest rate, that created the housing bubble, as we spoke about earlier. You don't look at the price when you buy a house, you look at your monthly payment. When you lower the interest rate by 67%, 2/3, the market of course going to respond by increasing prices of the assets financed. It's logic 101. During the last decade, a lot of financial crisis 1929 era regulation was repealed. That meant that banks could have higher leverage. Bank could invest in different instruments aboard the spectrum, which haven't been the case since the Great Depression. That meant that banks acted much more aggressively than they historically have done, and people, they blame the bankers to do so. But you have to remember, whenever the market gives you an opportunity to make money or to provide services to a demand out in the market, if you don't fulfill that, somebody else will. So like Chuck Prince, the CEO of Citigroup, he said, when the music is playing, you gotta get up and dance. So you have to understand that the regulation that were repealed, yes, that meant that the banks acted more aggressively. But they had to, because if they didn't, somebody else would. So instead of pointing fingers at the banks, you did this, you did that, you exploited all of us, you have to look at the government, because they made this environment possible. The banks could do whatever they wanted. There was no yield to get from investors around the world. It created a completely wild west on the financial market during that time period. But the blame is not for the actors on the market. The actors on the market just reacted to market demand. It was the frame set, it was the environment that was created by the federal government via regulations and via the ultra low interest rates. Today, 10 years later, we have a completely different situation that we had 10 years ago. There's no doubt that the housing market do not rest on a foundation of subprime loans. On the other hand, housing prices all over the world, especially in the big cities, are up to the same level as back then, if not higher. The stock market have tripled since it bottomed out in March of 2009. Junk bonds, that is low quality loans in the corporate world, not the consumer side of it, is at a record high. There has been extended so much debt in the junk bond world. But the canary in the coal mine, the elephant in the room here, is government debt. The last 10 years, all governments around the world have borrowed money heavily to paper over the problems that showed its face 10 years ago. Here in America, under Barack Obama, the federal debt doubled from $10 trillion to $20 trillion. That is, that Obama, he borrowed more money in his 8 years than all presidents before him combined. The story is more or less the same in Japan, in Europe. So before, we had a lot of bad debt, bad loans that blew up, created the crisis in the private sector, especially in the subprime area, in the low quality rated borrowers. Today, that debt have moved. It's no longer at the consumer levels. It's not centered on the consumer. We have some subprime car loans and such. But the elephant in the room is that the governments have issued bonds. The government have run deficits. The government have borrowed a tremendous amount of money. So when we ask ourselves, what is the next? Is there going to be another financial crisis? Nobody knows the answer to that question. If anybody tells you they know the answer to it, don't believe them, because if they knew it, they'd be multi-billionaires, because they just play the stock market, they'll do shorts or longs. Nobody knows for sure. But what you can say for sure is that since the financial crisis, the debt load of the world have not gone down. There's not been deleveraging going on. The debt in the society have gone up. In China, the debt levels have risen 5-fold in 10 years. 5-fold, that's 500%. So the world, more than ever, runs on debt. The question is this debt good or is it bad debt? If it's good debt, there's no problem with borrowing money because money can be used for investment. It's part of a society. It's always been. There's nothing wrong with debt if it's used productively. The problem happens when debt is extended to people who can't pay it back and when debt is used to finance consumption. The banks, the balance sheets look better. Back then, they were geared up 1 to 20. Now, there's difference of account, but right now, the average number here in America is 1 to 13. That means they are more resilient. They have a stronger balance sheet back then. But remember, 100 years ago, before you had the federal deposit insurance, where banks, they had to account for their own deposit. They guaranteed the deposits by themselves, and depositors were cautious who they're giving the money to. It was not uncommon that banks were only leveraged 1 to 5. Now it's 1 to 15. Back in the crisis, 1 to 20. So don't believe if anybody says we're out of the bush, it won't happen again. It can happen again. It's just a matter of time, and it's a matter about how stable is the debt situation right now. That question will be answered in the next couple of years when interest rate goes up. The problem with debt never shows itself while the interests are low, because everybody can pay when interests are low and asset prices are going up. Now, the Federal Reserve here in America have embarked on rewinding the whole situation. They are raising rates now. And remember, when rates go up, asset prices tend to go down. So now we have a situation where the borrower, that's private borrowers or commercial borrowers, they are facing a situation where the monthly payment on the loan is going up and the asset value of what they hold is going down. So it's a completely different environment we are facing. Last time when we started raising rates in 2005, it took 2 years, the world fell apart. We're at the same situation today. Rates have been ultra low for a long time. Asset prices have gone up. Now we're starting to raise interest rates. Historically, that means asset prices are going down. Will it blow up this time? Honestly, I have no idea, and nobody else does. The lesson from the financial crisis is not what to do and what not to do. The lesson is you have to position yourself in life to be able to cope with the ups and the downs. Because ups and downs will come. It's natural. It's a part of society. It's always been that way. So when you design your life financially, make sure that you anticipate these swings. If you don't anticipate them, you can be one of the guys who get washed out the next time the things blow up. Because blow up, it will. It's just a matter of when and to what degree. Remember, if you like this, push the like button, comment on it, or share. Or if you have some questions, just write me personally. Thank you very much.